Everyone, and welcome back to the channel. Today we're going to be diving into 5 discounted UK stocks that I believe deserve some serious attention in April 2026. These companies span insurance, asset management, airlines, and home building, and each one has unique value proposition that the market may be overlooking. As always, this video is for educational purposes only, and your capital is at risk, and past performance doesn't guarantee future results. So let's dive in to the first stock. So that is Legal & General, one of my favourite stocks to look at because they are one of the UK's most important financial institutions. When you land on their website, you immediately see the brief of what they do, like pensions, insurance, investment management, and retirement solutions. Legal & General isn't just an insurer, they're a multi-segment financial engine that touches nearly every part of the UK's long-term savings ecosystem. Their business is built around stability and long-term contracts. They help pension funds offload risk. They manage trillions in assets, and they through the LGIM, and then they provide retirement products for individuals and institutions. So let's dive a little bit into Legal & General and see how they've been doing overall these last few months. Now, as you can see, we just covered over what Legal & General are. But at the minute, at the time of recording, this is at 246 GBX. As I mentioned, it was based in the United Kingdom for financial services. It has a market cap of 13.69 billion. It IPO'd in 1979. It has roughly 10,500 employees. It's been growing its dividend for 16 years with a dividend growth of 11.95%. And at the minute, the dividend yield is at 9.06%. So that's quite good, actually. But the problem is, the last month, this is why the dividend yield is probably a little bit high, is because it sold off for about 10.37% in the last month and over nearly 6% year to date. So that is a bit of a pullback and an opportunity to buy Legal & General at a cheaper price than it was even like a month ago or even at the start of the year. Now, of course, like I mentioned, Legal & General do operate through some different segments. They got LGRI, which is their pension risk transfer business, which is their long-term liabilities from the pension schemes. The LGC, which is their capital investment arm, which invests in housing, infrastructure, and alternative assets. LGIM is one of Europe's largest asset managers, generating a stable fee income. You got retail retirement, and you got insurance, like we mentioned. And this combination, these segments create a diversified and a resilient cash flow machine, and hence why Legal & General can make so much cash. And I think that the standout metric is the 9% dividend yield. Now, like I say, it has been pulled back a little bit, the stock, but supported by the 16-year growth streak. It's extremely rare in the UK that the market and signal management's confidence, and it's hard to find a stock like this that has a high dividend yield that's still growing with the dividends. Now, this is a kind of stock that income investors will love: stable, predictable, and it's deeply embedded in the long-term financial trends. And if you do want a more in-depth video on Legal & General about how it properly makes its money, its revenue, and all its stats, there'll be a link down below in the description where you can check out the video yourself and watch it more in depth. So the second one is MAG, stock ticket MNG. Now, MNG homepage, investment products and saving tools, as we can see here. Now, when you visit the MNG's website, the focus is very clear. It's once again a long-term savings, investment, and wealth management. They position themselves as a partner for both retail and institutional clients, and it's built around 3 pillars: helping individuals save and invest, managing institutions' money, providing retirement and pension solutions. Their brand is built on trust, consistency, and that's exactly what their business model reflects. Now let's dive a little bit deeper into M&G, and as we can see right here, the price of recording is 272 GBX with a market cap of 6.44 billion. It IPO'd in 2019, has roughly 8,000 employees. It's been growing its dividend for just 3 years. That's what it says. And a 5-year dividend growth of 8.53%, and the dividend yield is at 7.51%. Now that's very good. Now let's see what they do. Well, like we say, they are based in asset management and savings. So what are they going to be doing? Well, they've got asset management, of course, serving the wholesale and institutional clients. They've got the life bit where they do savings, pensions, corporate risk. They do wealth, which is retirement and investment solutions. Corporate center, which is the group level operations. But overall, what makes M&G compelling is its cash flow profile. Asset managers generate recurring fees and life insurance contracts to create long-term revenue visibility. Now, like we mentioned, the 7.5% dividend yield is supported by the dividend growth rate of 8.53%. Now, realistically, the 5-year shouldn't really be on there because it's only been grown for 1 year overall. But I believe there was some other stats that says that the dividend actually has been along for longer, but it just hasn't grown. So when it did start to where it is now, it's 8.53%. So even though their official streak is only 1 year, the underlying financial engine is very strong indeed. As you can see, I have covered a little bit of the M&G financials as well. If people want to pause and have a look at what they are doing. Yes, as you can see, from where it started in 2019, it went up and then it stopped. And it's just been the same ever since, really. So that's probably why I can only find 1 year dividend streak on that. As you can see, the price target is high. So an average about 5%, nearly 30% upside possibility and all that. And the free cash flow is growing, which is pretty much good to see, better than from what the 22 year was. Okay, so Ramsden. So as you can see, Ramsden's website, as we can immediately load up, it's more like a jewelry, like foreign exchange, pawnbroking website. So this is quite diverse for a small company. They're not just a pawnbroker, like I said, they're operated in many different segments. The mix gives them resilience in both strong and weak environments. So when travel is up, FX revenue grows. When times are tough, pawnbroking and gold sales increase. So let's dive into it a little bit more. So at the time of recording, it was 350 GBX. It's got 109 million market cap. So like I say, it's a small company. It IPO'd in 2017. It has a dividend growth streak of 3 years, an average growth of 36% for the 5 years, with a dividend yield at 4.51%. So it is a micro cap. It has been growing consistently, but the dividend growth has been extremely impressive for a company of this size. The business model is built around high margin services and physical retail locations that generate steady foot traffic. But the thing is, a month ago, it is sold off for 14.63%. 6 months, it's down by 8%, and year to date, it's down by 6.67%. So it's pulled back a little bit. So, like I say, another good company to grab when it's a little bit cheaper than what it was. As you can see in the RFX financials now, only one analysis have covered the stock, and they are saying 550 for the stock to get to. Now, of course, take it with a pinch of salt. There's only one analyst to doing it. He might already be owning the stock. It would be quite funny if he did, if that's why he's saying that, because you wish that you can get upside on any stock you own. But as you can see, the revenue has been growing nicely for the small company. Free cash flow has been growing, but a little bit off the last few years. And of course, dividend growth as well has been fantastic. So now next on to the next one of mine, and this one's actually quite a favourite of mine. I actually used this a little bit back in the time, about a year or two ago, when I went to go and travel, and I will probably be doing that again this year because I would like to go and do something and go and travel the world once again, and that is always with British Airways. I love British Airways as a company, and especially the way the staff are, and just how the company's run. I just like how they are. And the funny thing is, I actually didn't realize until about a few months ago when I actually started stock market videos that British Airways didn't actually have its own company. It's actually owned by a group. Now, I never knew that because every time you Google British Airways, it came up with its own website, but it's actually owned by a group. So let's dive into it. So IAG. So when we visit the website, as you can see the airlines already there, nicely done. We've got British Airways, and if anybody can guess what the other ones are, that would be fantastic. But I'll tell you because I've got the answers. So you've got Iberia, Vueling, and Aer Lingus. Now, I'm not quite sure what the other one was in the picture, but I believe it's like a special one, or it could be a cargo. But like I say, I've got 4 listed on from the website. So they operate both passenger and freight services, giving them multiple revenue streams. So we can gather because they are a airline company. So if anyone is going to go on holiday, you will probably use one of those, especially if you're in the UK, because British Airways mainly fly out from the UK. So do EasyJet and all that, but British Airways is predominantly seen, especially when you're down in London. So if you're from that way, then you probably see British Airways. So say if you're up north, you probably see like Ryanair or EasyJet. So the time recorded is 349 GBX. Like I say, it's based in the UK. It's got an airline company, but it's got a market cap of 15.77 billion. It IPO'd in 2011. It has a dividend growth streak of 0 years, but a 5-year dividend growth of 36.08%. According to this, dividend yield at 2.39% as well. Now, so airlines are clinical. I lost where I was on my little note page. But IAG has been aggressively recovering post-pandemic. So their multi-brand structure gives them flexibility across different markets and customer segments. The dividend yield is modest, but the valuation is where the opportunity lies, especially when airlines tend to trade cheaply during uncertainty, and that's often when you find long-term investors find the value. Now, as you can see, the year to date is down 16%. 1 month it sold off by 23.51%, and 6 months it's down by nearly 9%. So it's a good time to get this company for a lot cheaper, especially when a year ago it's only up by 28.9%, but 10 years ago it's actually down by 6%. So if you invested this in 10 years ago, you'd still be losing a little bit of money, which is, yeah, not good indeed. But like I say, airlines do go up and down, especially for the last few years, it has been very uncertain. So let's have a look at the financials. I see why I did the 36% growth, because it actually started at 1.8% and then it dropped and then it came up again. So as you can see, they actually cut the dividends here during COVID, and then of course they go up. Now, of course, dividend stats are very vague, especially when you're on free services. So it's hard to find the correct detail. So the dividend stat may be wrong. But as you can see, that does have a dividend from 2025, and it will have its next ex-dividend date in June 2026. The revenue has been growing slowly, not impressively like Ramsden, but it has been growing, and so has free cash flow, which is good to see. And it has got upside from 22 analysis that have been looking at the stock. Now, we have got the people that build our homes in the UK, and that is Permission, or Persimmon. I don't know how to say it, I'm just going to say Permission, but it's definitely not. But anyway, their website highlights the scale and brand diversity for which they operate. So as you can see, they are a home building company. Now, they have multiple brands like Charles Church, Permission Homes, Westbury Partnership, Space 4, Brickworks, Tileworks. Those are multiple stuff they operate through. They are one of the UK's largest home builders with vertically integrated model that gives them cost advantages. Now, the last time I checked on this, as time recorded, they're at 1,068.5 GBX with a market cap of 3.44 billion, with a dividend yield at nearly 5.59%. Now, it IPO'd in 1986. Dividend growth streak is 0%, which isn't good indeed. Now, Permission has faced pressure due to the UK housing slowdown. That's exactly why the stock looks discounted, because 1 month ago it is down by 30%, 6 months ago it's down by 9%, year to date it's down by 21%. The year, 5 years, and 10 years are also in the red by 64%, 50%, and 10 years respectively. So, home builders tend to rebound strongly when interest rates stable or fall. Despite resetting the dividend policy, they have still offered a 5.59% yield, and historically they have been one of the most shareholder-friendly companies in the FTSE. Now, as you can see, so revenue has been growing from 2023 to 2025. They did drop from 2022 to 2023, and as due to that, they lost a bit of cash flow, of course, having to cut their dividend streak. And as you can see, the dividend has dropped and cut massively from the 2.4 down to just over the 60p. It's actually at now 0.4. So yeah, so it's a 0.4 dividend, and then as you can see, the price target is upside, so minimum, average, and max. You got 21%, nearly 50%, and nearly 69% in terms of price targets. So Yeah, pretty much good. They're all the five stocks that pretty much I think would be worth adding, especially in April, especially with the pullbacks that we've had lately. And if you definitely enjoyed this deeper dive, where we break down which each company does and then go into your financials, then make sure to go and check out the support links down in the description. Leave a like, hit the subscribe button, and I will see you on the next one. Goodbye.